And so when you talk about pullbacks in gold or gold being at peak gold, look, even Jamie Dimon's talking about $10,000 gold down the road. This is not just the gold bug camps anymore. Jeffrey Gundlach is recommending 25% gold allocation. Morgan Stanley, of course, their famous 60-40 stock bond portfolio is now 60-20-20. Goldman Sachs is recommending gold.
The Fed is going to ease a bunch. That can also affect the gold price depending on why they're easing. If they're easing because of economic fears, it may actually boost the gold price because people may take that easier money and put it into gold. We'll have to see what the financial houses and the commercials do. Are they going to take that money and put it into gold? If they're going to take and reinvest in their companies, gold may fall a little bit. It depends on how much the Fed eases, and it depends on how bad the economic data is. Now, I will tell you this. If any of the worldwide economies officially announces a recession, that's going to boost gold higher regardless of what people are doing in these paper trades, these derivative markets.
In this in-depth discussion, Matthew Piepenburg and Robert Kientz explore the potential future of gold amidst shifting economic conditions and central bank policies. Gold is no longer just a niche investment. Major institutions are signaling significant opportunities, with some predicting prices could eventually reach $10,000. Portfolio allocations are increasing, reflecting growing confidence in gold as a hedge against uncertainty. The conversation highlights how actions by the Federal Reserve could impact gold's trajectory. If the Fed eases due to economic concerns, the added liquidity may flow into gold, pushing prices higher. Conversely, if stimulus funds are reinvested into equities, gold could face temporary pullbacks. Derivative markets, commercial trades, and institutional strategies will also play a crucial role in shaping price movements. Experts stress that an official announcement of a global economic recession would likely drive gold prices even higher, regardless of activity in paper markets. Investors are encouraged to watch economic data and central bank decisions closely, as these factors will largely determine gold's path in the coming months. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now, listen to the interview.
So I fully expect gold to go up in 2026. I expect silver will too. Now, silver also has that unique aspect of it's more industrial, and there are massive shortages in terms of mine output, yearly mine output relative to yearly use. So we're running out of above ground stockpiles, and we saw thinness in London earlier this year. The COMEX had to send bars over to bail them out. So right now we're okay in the amount of silver, but pretty soon we won't be. So for those reasons and the economic reasons, I expect silver to continue to march up as well. So this is all happening when gold had a bit of a small little pullback here, not a big one. I mean, we're talking since October. So this chart goes back December of last year. So it's basically a year-to-date chart. You've seen this big rise in gold, a little bit of weakness, and that's people coming off of certain trades which aren't profitable and selling their gold positions. But there's other reasons why gold is sort of sitting there, not moving as well, and that has to do with currency. This is the gold price to the dollar. You can see down here, I've graphed the DXY to pull it off to just show what's happening with the dollar index. The dollar index is going up, and I'm going to explain the next two charts why really quickly. It has to do with the euro and the yen weakening. But the dollar index, as compared to these other 4 or 5 other world major currencies, is strengthening because all these other economies are going into recession. So if they're going into recession and they're not trading well, their equities are not going to do well. If their equities are not going to do, what happens? People in these leverage positions, this paragraph right here, in these other markets are having to cover those losses. Why? Because these other markets are going down. So the currency strengthening is a sign of U.S. trade strengthening relative to the other economies. And so that's forcing a temporary rise in the dollar. And that temporary rise in the dollar is because of these other markets are weakening. So you have two things going on. The leverage traders are selling their leverage gold positions to make up for this. But at the same time, central banks and such are making it up. And so gold is range trading. But it's building a base because if we're going to have a crash of markets, gold's going to shoot through the roof because it is the ultimate safe haven asset. So that's why I say it's building a base. Some people say that gold is just going to fall and fall and fall. Man, I do not agree with that, but we'll get into that in my final comments. How do I know the euro is falling? Because I graphed it. This is the euro to USD. When you see the euro on top of USD, I'm looking up here at the symbol. That means this is the euro price in dollars. So if that line is falling, as you see here at the right-hand side of this graph that I'm circling on the graph, if that's falling, that means the euro is weakening. And I've also got the dollar index, or the dollar as a part of that index, strengthening to show you that the dollar is going up while the euro is going down. Why European economy is going down. That's why people are selling off some of their leverage positions on the COMEX in gold. I don't think we're going to have a big correction in gold and silver. You could have a wave down if the world really quickly in 2026, like I've said that if you look at Q4 of this year or Q4 of any year, consumer spending tells you how the U.S. economy is going to go. And with the jobs being down, auto delinquencies up, I'm expecting consumer spending to not be particularly robust. If consumer spending is not robust, we're not buying what? Goods from other nations. If we're not buying goods from other nations, what happens to the economy? They shrink. What happens to the currencies? They fall. Then the Fed becomes the lender of last resort, trying to hold up the entire world economy.
Experts predict that gold will continue its upward trend in 2026, while silver is also expected to rise due to both economic and industrial factors. Silver's unique role as an industrial metal, combined with shrinking mine output and dwindling above-ground stockpiles, is creating supply pressures. Earlier this year, the COMEX even had to move bars to London to cover demand, signaling tightness in the market. Despite a minor pullback in gold since October, the overall trend remains positive. Factors like weakening global currencies, particularly the euro and yen, and potential recessions in other economies are driving a temporary rise in the US dollar. This forces leveraged traders to sell some gold positions to cover losses, while central banks continue buying. Gold is range trading but building a base, positioning it as the ultimate safe haven asset if markets crash. Economic indicators, including consumer spending and job trends, suggest a slower growth environment, which could further support precious metals. Investors monitoring currency trends, central bank actions, and industrial demand in silver should remain alert, as both metals are poised for significant movement in the coming year. Let's get into the interview.
So I think we're in this short-term sort of gold's going to range trade around until we have one of these world economies go in recession. We'll talk about that at the end. All right. Now, this is the U.S. to the Japanese yen. You'll see in this pair, the dollar's on top of the yen. That's just the way they list the pairs. So if the yen's on top, then you know it's the yen price. If the dollar's on top, it's the dollar price. And so the USD relative to the yen is going up. That means the USD is strengthening because USD is on top of the yen. USD will buy you more yen, meaning this pair is going up. It's the opposite of the euro, where they list a euro on top. It's just the way they designate in the Forex markets. But you can also see I've graphed here the DXY going up, or the dollar relative to all other of those global major currencies, not just the yen and the euro, but all of them is going up. So essentially what we have, as I come off screen, I'm just going to finish this up and tell you guys really what's going on. Essentially what we have going on is that the dollar is overall strengthening a little bit because these other world economies are not strengthening, and that's causing some weakness in these economies. Okay, even as these economies weaken, but that's temporary. That happens at the beginning of a recession. And in fact, it'll happen up to a recession, and then for the first 60 to 90 days of an announced recession before gold will go back up. Why? Because people are selling their leverage positions in gold. Their paper, they get rid of the paper. It temporarily affects the price negatively. But as the guy at Saxo said, the smart investors, the savvy investors, and the central banks are making up for it. And you can see that down here when you look at the other reportables, the yellow line, these are the savvy investors. And the managed money, the financial houses, are also stronger into gold. So you just see repositioning out of some of this short leverage trade, getting out of the COMEX to pay off other debts.
Gold and silver are navigating a short-term consolidation phase, with prices ranging as global economies show early signs of stress. The US dollar has strengthened against major currencies like the yen and euro, reflecting relative weakness in other economies. This temporary dollar strength can create short-term fluctuations in gold prices, as leveraged traders adjust positions and sell paper gold to cover obligations. However, central banks, institutional investors, and savvy market participants continue to accumulate physical gold, offsetting temporary market pressures. Even during the initial stages of a recession, these strategic moves support the underlying value of gold and silver. Silver, with its industrial demand and limited supply, faces additional upward pressure as global stockpiles shrink. Investors should watch key economic indicators such as consumer spending, employment trends, and central bank policy decisions, as these will influence precious metals in the months ahead. Gold and silver remain critical safe haven assets during uncertain times, and strategic positioning now could offer significant advantages as economic volatility unfolds. The market is temporarily adjusting, but the fundamentals for precious metals remain strong. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.